Buddy, hopefully you can hear me. I think it's getting through, audio is getting through to Zoom. It does look like it is. Okay, good afternoon, everybody. What a wild day this has been. We haven't seen volatility of this magnitude in the markets since like the financial crisis. Certainly in the row crops, maybe going back to 2014 during some of the summer periods where we're trading weather markets. It's a new pill to swallow and certainly a new news events that we have to digest here with an invasion of Ukraine. And with all that being said, remember, trading futures involves risk and is not suitable for all investors. And everything we talk about here today, it's not a direct trade recommendation. But if you do want to get in touch with me, I can always be reached over here at Zaner at 312-277-0110, or shoot me an email at dhussey@zaner.com. Always here to have a conversation about how to make some of these ideas work in a trade plan for you. So I think today is kind of the theme of today's market here ends up being a reflection of, or today's video I should say, ends up being a reflection of today's price action. And so if I was to title today's webinar, it's I can't believe what happened this morning. Wow. And that is a good representation in just a few words of what we saw. But that is also the mentality you have to take, that when you hit as a trader, you have to take a step back, look at the bigger picture, and reassess what the new normal you have just experienced is. And in this case, it's volatility. For crude oil here, we've got a range on the day of almost $10 already. The soybeans over $1. You have bull spreading going on in some of the calendar spreads we're going to look at in a minute, and maybe that might be the canary in the coal mine of where there's still opportunity here for row crops to catch a recovery, and ultimately also digesting the fact that we are into uncharted territory on many charts. Right, we are hitting new contract highs. We haven't been to some of these levels in a decade for ones like crude and soybeans. And there's a reason that when we back off these highs, we're met with a flurry of panic selling, which is, I think, a lot of what we saw today. It was profit taking into panic selling, in that maybe, I don't know, margin calls and other reasons, would be contributing to, right? So let's begin today with the dollar index. We haven't looked at this in a while. We're going to probably run through a lot of bigger time frame charts. Certainly talk about ways of protecting some positions here, but initiating new positions in this type of volatility, I think it is best, to start looking at option strategies and such. If you're not willing to digest what being long futures does in this type of environment. But that's the nature of the beast, and with risk comes reward, but also the risk of that loss. So dollar index here pushed up to its highest levels for 2021, breaking through that 97 handle and almost getting to 98. We did fade back down into the range for the day, but this move in the dollar is reflective of a risk off situation. We're seeing commodities rally with the dollar. We saw the stock market fall off with the dollar rallying. And to me, this is a flight to safety. If you look at the 10-year note today, I believe we also saw there pulling it up on the small chart here. Let me flip over. The 10-year note did pop up here and catch a nice bid here today. And the idea, it's faded back down, of course, as the stock market, I think, catches a recovery. I think we were down almost 600 on the Dow when Biden began speaking and addressing. We're only down 141 right now. So this spike we saw in the treasuries, reflective of the spike we saw in the dollar at the same time. You usually don't see these moving in the same direction at that period, but that's the flight to or risk off or flight to safety we saw in this environment that is reflective of either a war or a financial crisis. Okay, so that was something new we saw today. We haven't seen risk off in a long time reflected on the charts and in the markets, and that means that almost all risk assets, whether it's Bitcoin, the S&P, even some carry trade currencies, and at times the speculative positions, hedge funds being put on is speculative positions hedge funds put on, excuse me, got interrupted by a text message there. Those all get paired at times. And so profit taken from the highs in markets like crude, once we go through certain levels, soybeans, corn, everything today seem to maybe get triggered. Um, when you take a step back, though, and if you wipe away that explosive move we had to the upside, which you can't ignore happened, we really didn't close on the day too poorly for any of our row crops. It was unfortunate to see May corn or May soy, or excuse me, May wheat, if we're starting someplace, not quite close limit up. But it was good to see the March contract do so. And in doing so into its delivery period means that there's not going to be limits here for the March contract now. And it will be interesting to see how wild wheat actually gets in this environment. And I think I overlooked the fact that March is still trading. And I was thinking May needed to close lock limit. But March actually did. And that was that's a factor here that changes the dynamic for wheat into tomorrow. And it's like wheat said that the wartime mentality of fear and risk off in the market, because seeing wheat go limit up is also kind of a risk off idea, right? There's a flight to safety in wheat in that if all else fails, that you can eat the commodity and survive. There's a World War III almost bid going on in wheat that was not reflective, in the sell-off of crude oil, and that is something that makes you question, how long-lived this news cycle of I've got crude up, and that's a daily chart. Just what a reversal on the day there on that small chart on the right. It makes you wonder how much of this news cycle being driven by this invasion in the Ukraine is it getting exhausted here. This sell-off also occurred pretty much in tune with first the rumors and the talk early this morning of another strategic oil reserve release. Let's flip to crude real quick because we're kind of talking this. We're talking the wartime type of or war fear charts being built up here, right? And the move that happened today, and trying to see how it's either confirming or denying that consensus. And crude's almost calling wheat a liar here today. But this, of course, crude, the strategic oil reserves being released that Biden announced, that really sent crude down from 97 down to 92 once he began speaking this afternoon. That was just a wild collapse. And when you step back on the charts, you see how we came almost all the way back here and filled a gap at 92. Yeah, it's been a long time since I've seen crude move this much in a day. I think that is true for any trader. You've got to go back to, our November of 2021. We had one substantial sell-off from 78 to 76. There's strategic oil reserve releasing, being talked about and going on then, right? And then before that, you got to go almost all the way back to 2020. Not going to bother today because that's a moot point for the level of volatility, that we're now starting to see on crude oil. All intents and purposes, it's still a higher high and a higher low today for crude. But the way we close with a doji like that, the market almost has to now prove itself once again to me before I'd want to be a really committed long side trader, because this was a tough pill to swallow and stomach. And congratulations to those that are willing to hold through this type of price action on the long side. But at some point here, you have to be aware, below 91 here on this chart, below certainly this trend line at 90, things really fall apart for crude. And we're closer to that threshold now than we are to the highs. And, the trader in me says any chart that looks like this, if you're not at least considering a top could be forming, I don't think you're looking at the full picture, right? Not saying a top is forming, but wow. I actually am surprised we kind of bounced back above 92, I'll be honest, here since we spiked down to 91.50. But as you can see here into the end of the day, into the close, crude is slowly tapering away and fading away from being up at all. So very worrisome for the long side. And a bigger pullback on crude, $15, $20 off the high to 85 to 80. Maybe sets back. Remember, we've been in an uptrend now in the crude oil from $6 on the daily chart. So these big swings and pullbacks we've seen, a pullback to 80 is just another, multi-day, maybe month-long kind of consolidation that crude could go into. And a candle like today has a high probability of starting that type of reversal. And that's that has yet to prove itself, of course, but I think below today's low at 91.45 now, and certainly below yesterday's low, would constitute a very big reversal warning sign on the crude here going forward. So that does not bode well for crude, corn, which I think got a sympathy bid here over the last several weeks with the crude oil. But it's also interesting to see corn kind of ignore wheat today. So let's begin our row crop discussion with the corn, because we did close positive. It was ultimately still a good up day for old crop corn. New crop did finish negative, and we will look at that July spread, because I think that again might be the canary in the coal mine, warning us of the true commercial commitment to the long side here. Whoops, I'm grabbing the wrong chart. Here I am moving around my broadcasting thing and not the actual chart. Okay, overbought conditions that began here over the last couple of days have crept in on our side. That can remain overbought as long as this market wants to, but it is a warning sign. Any kind of reversal, like tail and candle, candle wick on a chart like this, you got to consider the ability for a market to reverse. And the failure to have stayed black limit up today was not a great sign for corn either. However, we did pull back into a area in the chart that I would consider broken resistance, now support. It seems to be holding somewhat. And hey, we just had a almost $2 run up, or over $2 run up, I guess, from $5 to the swing lows, from September of last year to now the swing high at 716 in the May contract. That's quite a run. A couple days and a little pullback to reestablish support before marching higher, not out of the question. The 18-day moving average is so far below us. We've pushed many standard deviations now above the old range and the old channel that we were holding. So this is all intents and purposes a breakout for corn. But in doing so, we have to remember breakouts oftentimes pull back and trace to try to test support. And now, I think that's a good segue into the smaller time frame chart here for the May corn. But before we do, 200-day moving average way below us, $1.20 below us at 572, 100-day at 589, 55-day creeping up at 616, and that 18-day at 645. I mean, it's very overbought. The trend trader in me says we should continue higher, but the momentum trader in me does say that we should get bull markets climb a wall of worry, but a top could very well form off of the price action we saw today. Something to be, I don't want to say concerned over, but it's a reason and rationale to now dial down into the smaller time frame, right? To take a look at the hourly chart. Are there supportive levels for trading that makes sense? Okay, so great trend that we've been tracking on the way up. In this trend on our way up, and the last swing, I was defining this by a 50% pullback and three-wave pullback here in the May corn that began from that 659 high. Let's imagine for a moment none of that price action happened. We had that open gap. We were leaving at 622. This is retraced to last week, what we were talking about, right? Market has now exploded out of its trendline resistance, went to not only negative 23, but negative 61.8 upside targets. All intents and purposes, this was a breakout for corn on the hourly chart too. I'm going to remove these old fibs because they've already gone up and through targets, and there's going to be new supportive levels, a new round of buyers that need to step in to support this market. So the extended long 660 high to high here, perfect 50 back to the 687 support that we were kind of traded into around today, off of that gap or off of that limit up high. Now here's another conversation we need to have. How do you handle a limit level and price measurement, right, on a chart when really there was a good several hours worth of trading that actually occurred and the option market that allowed this market to trade as much as 15 cents above that at one point. I think we were trading, if you looked at the front month future options, we were trading as much as 15 cents above the limit on those calls there in the overnight session when we were, pressing up at our highest levels. So how does that factor into price action? I don't know how to answer that because, many other markets I began trading my career with don't have limits. But it is something to consider that corn probably would have traded higher here in the short term, but it wasn't allowed to. But nevertheless, we ended the day up 5 cents and backed off the highs by 20, and that's not something to ignore either. But corn isn't, this isn't, an untypical day for corn. I like to take us back to, what was the date here? February 10th. A great example. We broke out on February 10th up to 660. I believe that was a new high at the time. Yes, it was. And then we spent the rest of the day selling off into, a pullback that ended 20 cents lower off that high. That's a very similar type of trade that happened today. We just happened to go all the way up to limit before the 20-cent pullback off the highs. So, well, actually, I guess this is a 30-cent pullback off the highs. But again, we went limit up still here, right? This is a much bigger move. So, all right, the pullback's a little bigger, and the magnitude's bigger. So I'm not totally convinced that corn might not find a support here, before the 680 area. If we do fall back down, though, we run the risk of testing back towards that 660 area that we broke out from. Could it be support? Absolutely. Broken resistance, now support. That could be an area in the chart we find. But ultimately, if we start to break down much more, slide below these lows and start to reverse, candles here and reverse and make today's candle look like the start of a bearish engulfing kind of structure, which would mean we start off the evening down, break below 679 and don't really look back. Because there is some trend lines and stuff that would come up here around 662. But if we start to break down, what would stop us from getting down here? There's an open gap at 622 that worries me. But we're until we totally put in a top here, it's tough to say that is a level we're going to go down to achieve. But gotta be somewhat conservative in your analysis and your approach. We can't ignore that level's down there and would be like a target on the back of the bulls if we start to and continue to sell off. So watching closely to make sure that doesn't happen. I think that this pullback, if we weren't long already in the corn today, if corn is going to follow the wheat, if Ukrainian acres and there's still going to be turmoil in Ukraine, corn and wheat both make sense to supply disruptions on the global balance sheet. While some of those supply disruptions, though, are probably going to get picked up, through China in some capacity and through direct deals from Russia to China or Ukraine to China, whatever. China is not unwilling to deal with whoever will feed them at this point. That could offset some of that instability in the region. But if fighting continues, this is also, what fighting continues, what type of infrastructure can go to then supporting, right, agricultural production? So we're down to, several weeks here before you really start thinking about beginning the next, a planting year. And the Ukraine is, finding itself in the midst of civil war, Russian invasion. I don't know what we call this just yet, but it's definitely Russia putting the squeeze on and taking control of the Black Sea for all intents and purposes. So lots of news can unfold. We don't know if this is the beginning of World War III, or is this going to be a quick, more or less quick takeover of the Ukraine, because there hasn't been terribly much opposition that would stop Russia at this point. I believe Kiev is scheduled to fall here shortly. We'll see. I think the other black swan that we need to be aware of, though, is what kind of message does this send to China? Are they eyeing Taiwan? And would this be the proof that Xi and an administration in China would need to make a move there? So there is a lot on the table here that can continue with this volatility, could certainly make that inflationary fear war bid come back that we saw on last night that took crude to $100 a barrel, has got wheat going limit up and sent all of our row crops higher. The pullback today could have been fund management of a lot of margin call-esque like issues having to deal with S&P dropping considerably and other wild volatile moves in the marketplace. That could have all just been bookkeeping at the end of the day, the pullback we saw. Because technically on a chart, you can see corn didn't really break any levels to the downside that suggests a reversal is absolutely in. It was still a green close on the day, and we held a level that ultimately, to me, could be a trend continuation level. It's got a base and prove itself still. It's still a falling knife off that limit move, but it could prove itself here. We'll come to soybeans in a minute, but I actually want to look at that July NOV spread before I totally forget about it, because it is, we're 20 minutes in here, so we still have time, but I can't forget to cover everything. There's just so much to talk about, and I think we could talk for hours regarding today's price action and try to digest everything. We will hop and look at crude too in a little more detail, but if I have time. But I really want to cover the row crops because I think that crude's got much more of a geopolitical caveat to it. You have the U.S. dropping SRP, or the Strategic Oil Reserve, and row crops don't have that. I don't want to call it manipulation, but don't have that other noise going on. There's a clearer fundamental trade going on in the row crops that we were setting up for before any of this happened, and all of this just sends that into overdrive, in my opinion. And I think a lot of people, a lot of traders, myself included, I'll be the first in a minute, we're very surprised by soybeans and how heavy they were today. Then again, if we're going to $20 soybeans, this is the type of price action of how it gets there. And I say that with the experience of watching a lot of currencies trade through central bank interventions and a lot of financial turmoil, where it always opened my eyes when we went from having 20, 30 pip, 100 pip ranges to now 2, 3, 500 pip ranges. And you'd say, wow, we just lost 200 pips on the day. I bet we're going lower. And then all of a sudden we close back higher. And 200 pips, by the way, those are massive moves. It's like, it's like soybeans going from a 20-cent range to an 80-cent range. Very similar type of widening of volatility. All right, July NOV spread in the July D spread. Your old crop, new crop spread here, I think said it all. And actually, if we look at the intraday price action on it, it was kind of a fight over this spread all day long. And I don't think that the way we closed the day here, this to me doesn't look like a spread has topped per se. I think that this spread is basing and forming higher highs and higher lows. And it's putting up a fight here. It's trying to break through, hammer through levels to the upside. I don't think it's trying to put a top in reverse just yet, in my opinion. So I think we have solid support here down around 60 cents over on this spread. 85 cents over highs traded on the day. We've basically been in what I would call, if you're an Elliott waiver or you look at this as a technical structure, this looks like 3 waves in a corrective type pullback. We're holding, very aggressive trend lines as this has turned parabolic, as these spread markets often do this time of year. And we're starting to take away the carry out of the market and really build into that dichotomy of backwardation, right? In doing so today, we actually saw a pretty big move. This pullback we saw, this bear spreading we saw. Well, first, the bull spreading we saw, where everything rallied and went, limit up in corn. And then the bear spreading we saw early and often that started to walk new crop off of its highs. And then the bear spreading that ultimately took over into the end of the day that walked, old crop corn there, or walked new crop corn back down to close at 604, with new crop corn, closing at up 11 cents at 695. So one closing down 6 cents, the other closing up 11 cents. Was your difference of your swing there of the beans being, or both corns being up 30 cents together, and then falling back down to the levels they did respectively, with December corn getting hit really hard here. So this rally we saw was just utilized by commercials to bear spread out, maybe to get, or any producer for that matter. We saw a wall of selling in new crop here getting done today that encouraged the market to come off of its highs somewhat. But ultimately, we still bull spread the day. And we're still bullish, I think, from the fact that we have been unable to kind of crack back below and give back the gains we saw on the July no spread. And if this continues to hold here and puts in a low at 70, I think that's all the reason that, watch the outrights, put in a low, try to hold maybe and fight to get back above $7 in your front month futures. The front month futures then take over to the upside. Your bull spreading will then, continue to continue here. And I think ultimately that will drag your December, new crop up. But, in a year where if we get to the type of move we saw last year, we're going to expect this July no spread to, go substantially higher. It was, last year alone, this spread for 2022, not the 2021 spread last year. We're talking the 2022 spread a year ago, right? Hit $1.12 higher. So in the current marketing year, this spread can go to $1.50, $2, $2.50 wide. If we see a real weather market hit into this springtime and real drought and continue into the summer, that's the type of weather market that could take it there. Well, we're certainly already starting to march higher, and today's news, I think, was a commercial rebalancing event in many ways. I think there were hedge funds and commercial entities in every market, whether it be crude or the ag products, utilizing today's volatility and big spike in the overnight to get some serious volume done at levels they wanted. And once that seller was, more or less complete here, I think you saw the market kind of exhaust itself to the downside. But that is still, me being hopeful that the market is going to be putting in a low and finding a reason to still remain bullish here. And again, we looked at corn there on the short or on the outright future. It's hard to, do you mind grabbing that? Corn here in the outright future, it's hard to see this is totally bearish yet with still a green close on the day, and holding here and bidding up inside of this wick is a very, very bullish signal. But we're at a line in the sand, and it's definitely a do or die moment. The canary in the coal mine still sits here, in my opinion, with the old crop, new crop spread here for December corn. And I think that this today's price action, with it still remaining bull spread like the outright futures, could be a signal to not give in to the bulls just yet. Okay. Man, getting yelled at by Zoom. Got 10 minutes left. So we get cut short. You guys know where the recording is. Do pick it up there and follow. Moving on, let's get into the wheat really quick because wheat's very simple. We'll go over the technicals here, and then March wheat here has now blasted off the last few days. We've left all of our moving averages kind of in the dust. We're up above $9. We're going to new contract highs and the highest levels we've seen in wheat in a long time. Having closed limit up, not much else to say. Support's probably around $9 if we see it ever again in the wheat. Sorry, let me pull up that chart. But do keep an eye out here for news out of Ukraine and what have you, because I think it's just 100% driven by that right now. And if anything, in my opinion, wheat is saying it all. So I do really want to get into the soybeans. Yeah, nasty day here. Look at this daily chart for the soybeans, down $13. This type of chart does feel like a top in many, many ways. But I'll show you in a minute how there is some support around the 4-hour and other areas that we can consider. But the momentum coming off of this high, I feel, might catch a multi-day downtrend. When we go back and we look at charts from 2012 and 2014, I apologize not for having any ready right now. You see similar days of this magnitude. Usually they're around like WASDs and other things, and not on the back of like Ukrainian news, Ukrainian invasion news. But they're there. And the idea is that we set up an environment of a tight balance sheet and the fundamentals for a very volatile trade anyway. Throwing more coals and more fuel on the fire here is just exacerbating the volatility and the amount this market's moving. So really wild day. It was certainly, if you think of it in terms of alarm bells for risk, certainly the type of day today where you got to think to yourself, wow, what a is this level of volatility worth wading through? Well, let's take a look and dive down into the charts a little bit, and we'll see where some of the support might be from, and how in very very strong market movements like this, it can be there can be opportunity sometimes, but at this point, for new positions, certainly, soybeans, I think, would need to prove it to you before entering them. But I also am fearful of chasing shorts from here, because I don't know how limited the downside might be if we continue to see limit up moves in wheat and other things. If this war goes on and becomes more protracted, I mean, there's just there's a lot of eggs that could fall out of the basket. Now, one other thing that could be happening here with the soybeans that needs to be considered is China. What if trade with China shut off? And what if the soybean price starts to reflect that? China's already starting to side with Russia in this whole equation. It sounds like they're already probably starting to layaways and deals to keep commodity trade and money flowing to Russia without U.S. SWIFT and banking sanctions coming down on the Kremlin. But China has its own sights set on Taiwan. They've been stockpiling grains for some time now. They've been buying as much as they can get their hands on everywhere. If China is going to back Russia, or I don't know. I'm just trying to point out that there might be a black swan here of negativity that could hit, that we don't want to, that we need to be aware of too. And there's just so many things going on that sometimes it's best to start, reconsidering and then stepping to the sidelines. So that's where I'm at soybeans, right? I'm trying to think, is the big picture unclear and getting foggy enough to just step to the sidelines altogether? Technically on a chart, we had a negative down day that you can't ignore and should be a red flag. We've seen down days, not of this magnitude, but if a similar kind of pattern where we've sold off to new high, or we go to new high, we sell off, we kind of put in this reversal, but then over the next 2 days, we'll bottom out very rapidly. We won't go much lower. We'll find a base and then continue higher into the start of the new month. But man, it's starting to be grasping for straws, right, for reasons to stay long beans, especially on a day like today. So it wasn't, no longer higher highs and higher lows. This would be considered, a reversal day, confirmed by tomorrow if we break down through lows. But support did hold here for 8 hours here at the 1652 area, the last 4 hour trade, I should say, into 1652. That was a 50% retracement, and it's also starting to align with the prior highs here. That's a tough area to hang on to now at this point, but for all intents and purposes, we're still above trend lines. The market is still very volatile, and I still think a retest back to $17, at least as resistance, might be in the works. I'd hate to see the market go down below 1620 to 16 before giving a rebound or sell, but if we start to go down below 16, I might shift the cap altogether and start talking about this as a near-term, near marketing top, and wanting to be maybe more a part of the short side. That hasn't happened yet. And the volatility of the last 24 hours has certainly has me, though, reconsidering the long side altogether on soybeans. But not willing to throw in the towel just yet, but very close to that line in the sand, in terms of what I need to see to think of a bull market's continuing. So, new normal, best to take a step back, look at the big time frame, see how much chart we've covered so far, how much the market has moved over the last year. Volatility is a function of that progress sometimes, and we're witnessing it firsthand. So I think the risk-off mentality of the markets is still going to stay. Sometimes our row crops and other commodities can follow that as hedge funds and big liquidations occur in other markets that we're not really aware of, or really not privy to, because funds are always rebalancing and moving that money around. But we very well could see a change here. So July Nove soybeans, and I'll bring up that soybean chart and go through the shorter time frame levels, because I do want to break down all the way to the minute chart, but we're running out of time. July no beans channeling higher up towards $2, kind of get rejected there. I feel that was a technical fundamental rejection of a first test of $2 over. We back off to test yesterday's high. In the short term, there's still a short-term channel that we're trading up here too. And if you look at a 4-hour chart here, this is not as bearish as the beans are. In fact, this is quite a bullish day, in my opinion, having gone down, tested into yesterday's range, held support, made progress back above yesterday's highs, and closed there. This 184 over settlement up 11 cents on the day, the July no beans, is another reason I'm not quite given up on the soybean progress on the chart. If we fall back down and go below 170, it's hard to say we're not in a range and we couldn't break back down. But if we're really breaking out higher, if we've gone through old resistance, tested as support, we're marching back up, and we break out of the $2 over mark, I mean, how are we doing that? That's not usually, we're not getting bull spread here by by our futures going down in a different ratio. Usually that's happening because our front month is rallying and dragging our back month up at a slower pace. So canary in the coal mine here, I don't know, but this was not a bearish day for the spreads, which is why I feel end of month big news event, lots of margin calls, might have been more portfolio rebalancing for hedge funds and what have you than anything else. But going back to that soybean 4-hour chart, because I think I had that bigger one up, so you can see that 50% retracement here. There is a new kind of inflection zone that I'm interested in, right? This old one, it was highs to highs, didn't quite get down to the 1527 support. That's fine. But some kind of swing, I'm interested in monitoring its progress from the 1550 low to the 1759 high. That $2 swing, we've pulled $1 back here. Could we test the 61.8 line and down into this trend line support? Yes, we very well might. But I do think we're getting closer to a supportive area on this chart than we are to, the short-term high at that point. Then again, we start to break down, and I think below this trend line, below 16.20, below $16, now we're spelling a much bigger pullback. And I don't see any reason why you can't at least think about for a second the full 50% pullback from $12 to the 1750 highs comes in at 14.80. Not saying we get there, but that's the 50% of the entire move. So. All right, well, with that being said, everybody, thank you for joining me here with the strategy today, our strategy of the week recap. Lots going on in the market. The volatility makes it really tough, I think, to get into futures positions, but that is where options become a good, viable trading strategy. Some of the, I think, recommendations I'll be making over the next few days, if I feel a low is coming into place, will be to the tune of, call spreads and calls, where we have some, if we think of low is forming, right? If we think that we're going to reverse and that the high is formed, we can turn those into put opportunities too, to be short this market. But I think that buying, the calls that have gotten obliterated today in this downside volatility is a great way of putting some of that production back to work for you. And using these big volume, big spikes in price and in the to do some cash sales, to get some forward sales done, I think is really an important thing to do, because you can always turn around and take that cash and buy a finite risk call spread or call to get that reownership done. And using days like today, where we have this big volatility on the board, where the board price has fallen $1 in soybeans, you can use that to your advantage of trying to scoop up low-hanging fruit relative to cash prices, which are going to reflect some of this volatility, but oftentimes are less volatile than the board price, right? So, with all that being said, hopefully reach out, 312-277-0110. You can always get in touch with me to open an account, get involved in futures trading and commodity trading, see what it means for to you, and to if it's moving into a new field or looking for an opportunity to manage your risk. We're always here to talk to you over here at Zaner. Find me on Twitter and Facebook. Shoot me an email, dhussey@zaner.com. And if you haven't joined below, do sign up for the Strategy of the Week webinar. There's a link here in the comment section and in the information section to join this webinar every week, where I send out a weekly email with the link and everything. And then also feel free to join our free weekly or daily newsletter. Those links can be signed up for or found below. It's been a long day, everybody. I'm definitely going to need the next couple hours to recuperate and reprocess, but I know it's going to be a long night for me as these markets, I think, are only just warming up in some of the volatility we've seen. Have a great day, everybody. Be safe, trade safe. Always use a stop. And remember, trading futures involves risk and is not suitable for all investors. Have a great day, everybody. We'll be back with you as price action develops.